Welcome to the Dividend Talk podcast, episode 58. Earnings season has started. Hey guys, welcome back to another episode of Dividend Talk. On this week's show, European DJI and I will discuss with you the most important news of the week, some earnings from our popular dividend stocks like Unilever, Roche, and Coca-Cola. We'll, of course, answer some questions from the community and provide you with our stock pick of the week. If you're new to this channel, please don't forget to like us on your favorite podcast player. That's how you'll never miss a show. But hey, let's get started. See you on the inside. Hey, European DJ, how are you this beautiful Friday evening?
Really good as always. I mean, I've been looking forward for the podcast. Had a tough week at work, private a little bit, so I was really happy. Looking forward for today, specifically because earning seasons has started, and it's so nice to now see what are the major trends of inflation costs and all this stuff. So yeah, I'm really looking forward for the show today.
Yeah, we had a nice week of earnings, and next week is going to be even bigger. So we have a couple of nice weeks ahead of us. I too was looking forward to this, and I think we should start maybe talking a little bit about Unilever. I know they released earnings, which we'll talk about in a moment, but they've been in the news for quite a negative reason this week, haven't they?
Yeah, it's really interesting. So if you think about Unilever is a holding company, right? And I understand that it's not Berkshire Hathaway as such, but it has some elements in it because it really tries to respect the fast-growing companies that it's acquiring and keep a lot of independence with them, because that's how it's an attractive company to do business with when you're a startup or a fast-growing company. So in this case with Ben and Jerry's, they have already like an acquisition agreement since the year 2000 approximately, and effectively they're many people don't know, but Ben and Jerry's has an independent board of directors, and they can do almost everything what they want. So Unilever cannot really intervene when it comes to their their branding, their communication, these kinds of stuff. So there must be a lot of trust from Unilever there. But what Ben and Jerry's did, they said, like, you know what, we're not going to prolong their deal with a supplier in Israel, and that's selling ice cream in I think it occupied Palestine, I think something like that.
Yeah.
Because they don't want to do business there. It seems to be too controversial for them, which got a lot of backlash. I know I saw it also on Twitter. Quite some people are calling for a ban. Also, one of the states in America has in law written in stone that if a company boycotts business with Israel, then also the state shall boycott the same products there.
Wow, I did not know
so yeah, now the Unilever CEO effectively also said that they are, as a company, not distancing themselves from Israel. So you can see here how these relationships really get tested, right, under these times and choices. I think they're trying to, smooth it a little bit out and hope it goes away. But I'm sure they had some tough conversations in the background there.
Yeah, mixing business and politics is a dangerous game. We know it goes on behind the scenes, but coming out publicly to declare something like that is really dangerous. I know Ben and Jerry's are inherently left wing, and I think it's well known that they are left wing, and they were facing some pressures from maybe shareholders or groups within their community that they were selling in these, so Palestine or in Israel, because of this. So they're kind of trying to take a stand against it, and that's fair enough. But to come out publicly and declare it, it could be, I don't know, suicide from them. A lot of people, we know how Twitter works, we know how social media works, we know how politically correct the whole world has gone lately. You can't express an opinion like that quite openly. So it's a brave move, and I think it makes sense from Unilever to come out and say, "Hey, look, this has nothing to do with us. They Ben and Jerry's make their own decisions. We're still working away because it could affect them. I mean, I hope it affects their share price and it drops 10%, and then people forget about it next year. But it's a bold play. Personally, for me, I mean, I'm not going to boycott Ben and Jerry's. I don't buy them too much anyways. As we spoke off air, they're quite expensive compared to other solutions. But I don't know. It could be a bad move from their CEO.
Well, I don't have any issue at all that companies, how you said, take a position in certain matters, because we're talking about ethics here. Yeah, for me, it's even more about ethics often than politics, but it's hard sometimes for people to split those two. There are so many, situations in which companies need to make a choice. For instance, think about child labor. Yeah, with your
Yeah.
suppliers. Yeah, it's a lot about ethics, and here then it's really a question: what kind of worldview do you have, right, on this situation, and is it important enough for you to make a statement? I actually like it when companies have a spine and actually follow their ethics. It's then for me as an investor to agree with it or not, and invest in it. So the choice is still with us to be shareholders or not. But I actually like it when companies have a bit of a position and a spine, because they do have an impact on the world, and ethics do matter for me in business.
When it comes to Israel, how long will this spine last from Ben and Jerry's? Yeah, I mean,
Yeah, this is such a this topic is probably as old as Jerusalem.
yeah,
But the one thing is probably good in the dividend talk. We don't shy away from opinions, right? So
no,
that's why we have this show, and I think we should be ourselves as well. I have totally no clue about Israel and Palestine from that point of view. I'm not literate enough from a historical point of view to actually even say something about this. But I always go back to human rights. When human rights are violated, then I'm against it. So, yeah, simple like that.
okay. So I think that's a nice lead into Unilever, who posted some results. The first 6 months of the year numbers. I think you had a look at them this week, had you?
Yeah. So what was very interesting that actually it gave the results gave a great buying opportunity this week. So I added some shares again when it dipped yesterday, because the narrative was bad around it. And so what happened? Why was the narrative bad? Although they increased underlying sales growth, so with 5.4%, that's their kind of adjusted earnings or something like that, however, before sales, however you want to call it. But their margin declined by a percent point, which has quite some impact in general on their earnings. But the biggest impact on their earnings was actually a decline of 2% due to currency impact. But also inflation costs popped up. So what you see here just is that not all the inflation costs can be easily passed on within the same quarter to the consumer when we think about pricing power. But at the same time, we shall also not forget that the majority of Unilever's sales are coming from the emerging markets like India. We have seen, of course, a severe lockdown again, which makes it hard to buy certain products that Unilever has in their portfolio there. So all in all, it's not such a bad quarter if you take it from that point of view. So their free cash flow was 2.4 billion compared to 2.9 billion in the first half last year. Well, the first half last year, they just had a better situation from that point of view to have sales, and the margins were therefore also higher. But I guess the general narrative at the moment with Unilever is that people are over the last 2-3 years not really seeing growth. Yeah, like proper growth of 6-7%. There's always something a little bit, and for me, it sounds a little bit like people are getting tired of Unilever, because they have all kinds of promises about spinning of new business, acquiring businesses, but you don't necessarily see it back at the bottom line, and people are strongly questioning whether their how is it, their company with social, with purpose is really also benefiting the shareholders. And this is, of course, already a trend that started under the former CEO. And I think people are getting more and more tired with it. A little bit into the technicals, what I can tell you is that they increased their debt a little bit over the last half year, and this is mainly done because mainly because of the share buyback program that they have running. So they are leveraging up a little bit because the free cash flow is covering the dividends, but not by a wide margin. So they need to borrow debt. But the buyback program is not bad. It's, I think, 3 billion, 2.2% of market cap. So they should be able to increase the dividend with that next year. And last but not least, they also give a small announcement on their tea business. So they expect somewhere later this year in October to conclude the separation. And they are now considering whether it should be an IPO, a sale, or a partnership. I'm actually mostly interested in an IPO because then I assume that we as shareholders get something out of it, some shares, because at least I can then myself decide what to do with it. I hate it like when companies do IPOs but let it turn back into their own balance sheet again. I rather make my own decision what to do with it.
Yeah. Kind of as you expect, I suppose, from Unilever over the last year or so. As you said, this year they haven't performed too well in the share price. They are down, I think, about 8 or 9% since the start of the year. I've been buying them up quite regularly this year. I'm up to about 100 shares. I'm not going to add any more at the moment. As we know, consumer staples is high on my too high a percentage of my portfolio, but if I didn't, I still believe in this company. I think they're a fantastic company, some really, really strong brands. So I'm not too worried. But as you say, investors get tired quite easily. I see it as a long-term investment, so I'm happy to see them just keep ticking along as they are.
And me too. I think this company has still so much fat on the bone that if they really wanted to, they could quite easily beef up their earnings if they wanted to. So, yeah.
Okay, good. The next company we have is Coca-Cola. Again, another one of your companies. I believe they did quite well. Eli Snowball will be happy, I hope.
Yeah, I think that's really good. And what we need to know, they came from really low levels last year, because last year they were heavily impacted in Q2 by the severe lockdowns in the Western world and in China and such as well. So their global unit case volume grew by 18%. And this is actually, if you would say it compared to 2019, they're even again. But this is all to do with the restaurant openings again. So the out-of-home consumption is getting back to normal levels again. So in America, but also in Poland, restaurants are open again. People can drink Coca-Cola again and all these kinds of things. So it really did them well. So their net revenues compared to Q2 last year grew with 42%. Now, again, don't take this headline number as such. It's really because the comparison of last year Q2 was like bottom of a decade probably for them. So all these numbers for me don't make a lot of sense from that point of view. But it's good to see that the company has rebounded again quite quickly from that point of view, because the world has not totally opened again. So having that in mind, I think if the world is totally open, it might actually be even better for Coca-Cola. And it's good to see after a few years again some proper earnings from Coca-Cola, because it was all the time a little bit disappointing, flat, while the share price was increasing, valuation increasing. So it's good to see it now also a little bit back in the earnings. What I like about it as well, that the company is more bullish actually at the moment. So they increased their guidance. They expect organic revenue to grow from 12 to 14%. So first they thought 12%, now 14%. And they also increased their guidance regarding the EPS to instead of 13% to grow by 15% on a comparable basis, and a free cash flow of 9 billion. That's what they expected. So at the moment, they pay out 85% of their free cash flow in dividends. I still think the company is heavily overvalued. From that point of view, it's a really slow grow company. From in my opinion, slower than Unilever, and it's not worth a 31 price to earnings. So I still find it way too expensive. But to Eloy Snowball, he should be happy, I think, because they have really decent earnings and good to see some actually some forward guidance increases from time to time there.
They're certainly not worth 31 PE ratio. Not in a million years would I pay that. But like you said, I'm happy to see them return to growth. I think it's textbook. I think we could have predicted this. Let's be honest. We know they hit rock bottom when restaurants and pubs and everything was closed last year. So they're starting from a low base. I still think we need to give them a year to see where the growth will be after
Yeah,
all lockdown is over, and we see where they are. And we'll see if they can certainly grow after that. There's potential there, obviously, but I mean, cash flow is. I think they pay the dividends is 85 to 90% of free cash flow. It's too high for my liking.
yeah,
They're too expensive. So I'm staying clear. I'm happy I sold them for now. I can't see their share price rocketing from here. I believe in the next 2 years I can still probably enter in around the same price, so I'm not going
yeah.
to miss a whole lot. So I'm sitting in the sidelines and waiting, but certainly happy for those investors who stayed invested and are keeping the faith with Coca-Cola.
Yeah. So
Okay.
I believe you have been looking into one of the Swiss companies called Roche.
Yeah, I mean, I mentioned this before. Rush is a really nice company. I love their annual reports, and I mentioned to you when I was going through them how connected I felt to them, and I mean, for a pharma company, I I felt like that they had the best interests of people, and I really got that sense from them. So I've been following them a little bit. They're starting to rebound quite nicely actually through COVID. COVID obviously had an impact on their pharma division, but overall they increased their sales by about 8% at constant currency, mainly due to the diagnostics division, which posted strong increase of about 50%. The pharma division is still struggling a small bit. COVID-19 testing is starting to reduce, as we know. So biosimilars are starting to have a little bit more of an impact on that. So they do have lots of products in the pipeline, and they seem to be going really well on that. So they're doing some studies, I think, for antibodies with Regeneron, about some, I think it's AT527 is what they're calling it. And Japan is going to be the first company to approve this treatment of COVID-19. So if this gets rolled out, that could be a huge money maker for them. So
Yeah.
they do all kinds of. I think I mentioned before, their R&D department is quite strong. They're very innovative, and someone I'm keeping a close eye on. Sales in Europe have rebounded quite quickly actually. So they've surpassed the 2020 levels. US is still kind of lagging behind, but there's been growth every quarter for the last 2 or 3 quarters. So I expect maybe by this time next year we'll start to see them back to where they were maybe 2018, 2019.
Yeah.
So and one thing I did like is that they have committed to raise the dividend again. I know they pay it yearly, but they've already committed to raising that next year. My only grievance with them is that they're a Swiss company, and it's the withholding tax is very high on Swiss companies. So it stops me from getting involved. But I think it's a really nice company for those who can benefit from investing in a Swiss exchange.
Yeah. I just hope that they will increase their dividends a little bit higher again with proper percentages. It's like Novartis all the time, 2-3%. Let's get back to 6-7% because that's what I need as a
Yeah.
as a dividend investor.
I don't expect. I certainly don't expect a 6-7% next year, and not at these levels when you see their figures. But I certainly would start to expect that maybe from the year after when we finally come out of this pandemic, and we
Yeah.
can start to see how they're actually new products are doing. Actually, I never mentioned that the new products are now 50% of their sales in the pharma division, which is quite high because they were always reliant on some cancer drugs.
Yeah.
So these new products are coming in, and they're starting to overtake these, which is quite
It's
positive.
always good to see it. It means that they have a strong pipeline.
Exactly. Yeah.
Yeah. Nice. Well, it's really nice to hear a bit about Rush. We actually talk too less about this company on our show. So
I struggle with Swiss companies because there's some really strong Swiss companies out there. but it's the withholding tax from my side, which is
Yeah.
35%, which stops me from investing in them, and then also stops me from keeping an eye on watching these companies. But
Yeah.
when I was looking at this company, I just got such a nice feeling that I follow them, and maybe someday I'll just buy them and
Well,
screw the
it's also
tax.
the effort you want to take to reclaim the tax, right? We
Yeah,
heard when you're a German citizen, it goes quite easy. So we have German listeners. For them, these companies are really interesting.
exactly, and that's why I mention such companies, because not everybody is from Ireland. We've got such
Yeah,
a wide range of European listeners that can certainly benefit from this company.
yeah. Hey, and then the next company that you looked into was Intel. Good old Intel. How are
Good
they
old
doing?
Intel. I love Intel. Actually, we had dividend day yesterday, and we always jump on when Intel's earnings after the historic Bob Swan 10% nosedive that they took last year. And we were talking about Intel shareholders, and I completely forgot that I sold all my shares in Intel. But it's quite a funny story, but I'm not surprised by their earnings at all. I think Pat is starting to turn them into a boring, predictable company. They're starting to say the same things for the last 2 or 3 quarters now. Figures haven't changed. They've been kind of flatlined. They've beat expectations, but I mean, come on, expectations were low. So I kind of expected them to drop. I gave you a prediction yesterday that they'd be down 5% after an hour. They were down 6% today, so I'm taking that as a win. I just feel like we had such a positive result from them in the last quarter. We had loads of announcements, and this is the path forward. But I think I mentioned it's a long-term plan. It's going to take 2 years to play out. It's not going to take 2 quarters. So I was completely expecting this to deflate investors, and they're not seeing results quick enough. Look, they have some good news. They've announced 5G network collaboration with Google Cloud. Their new IDM 2.0 strategy is now kicking off with the capacity expansions in Arizona. There's unofficial talks that they're in trying to take over, I think it's Global Foundries, to expand the foundry. That hasn't been officially announced or anything yet, but there's news in the background brewing. But overall, I think it was flat and exactly as I expected for this quarter.
So, I'm not surprised at all. Like you said, I'm not the biggest fan of Intel. I will buy it at the right price, to be honest, because that's where the value investor comes in. I also think they're not that. I just think they lost their innovation capability and they need to reinvest in that. That's where my hope is with Pat Gelsinger, this new CEO. So, and this is also where I was really disappointed. I didn't hear an engineer yesterday when I dialed into a call. I listened to a wannabe CEO who isn't a CEO. Like he's not a Ivy League graduate, and even if he came from there, I can't be cared. The event earlier this year, you heard an engineer talking who knows his shit, who knows what to do with the company. Now, if you read the press release, and you heard him talking, he's trying to talk like I don't know, like a CEO, but it's all fluffy. It's not pet. So for me, it's like give me pet back. Don't become totally influenced about all these white hats around you. Just stay an engineer, do what's right, have the right people around you, have a strong CFO, but focus on the engineering and not all the shit around it, and don't use empty terms. That's what is not what I expect from Pat. Pat should stay Pat.
You do you, Pat. I mean, when he came onto the scene and he was giving us all his ideas, and it's easy to get excited, and he had a roadmap, and this is what I'm going to do. Okay, and I can understand. Okay, he's an engineer at heart, and he's given all these ideas. Now he's in the nitty-gritty of things. He's been there 2 quarters nearly. He has to give results. There's nothing there to get excited about as an investor. Nothing. Okay, so
No, but
if
an engineer says that.
but you also have to be wary that if he does say that, the share price tanks, and he doesn't want
Share
that.
price tanked anyway.
It tanks anyway, but it will tank more, and then you have board of directors who are going to be unhappy, and you get internal pressures. There's a lot of politics that he has to play, so I can understand why he doesn't come out and say, "Okay, look, we've
But
done nothing this
I don't
quarter."
agree with this because if you remember, what's his name from T-Mobile, the guy, John Ledger.
Yes,
Yeah, he
Yeah,
built his own reputation around it. Pat can do the same. It's about how you show up, how you set your own boundaries. Pat can stay Pat. Pat doesn't need to be an empty shell like the CEO from IBM. He should just talk no nonsense. I understand that he doesn't want to say our company is shit because you demotivate your people and everything. I fully understand that. But read the first page of the earnings release and tell me again that those are not meaningless words. They don't tell you anything. And this is what I didn't like about Pat.
yeah.
So for there, I'll stop my monologue about Pat. But Pat, if you're listening, stay Pat. Don't get influenced about all these other heads around you.
So overall, a very bland. Nothing really happened. They beat low expectations and they move on. I'm hoping they drop under $50. I might start adding. I really want them at 45. That's my buy target.
Yeah, I might join you at that time. I don't know yet.
You will. I'll convince you by then.
Super.
Okay, Kimberly Clark. Oh, we talked a lot about inflation, and I know you have a video which I think relates to Kimberly Clark on
Yeah,
that subject.
correct.
So I'm quite interested to hear your take on their earnings, actually.
Well, everything that I thought about, and this not to sound cocky or something like that, but when we had this conversation in one of those podcasts as well around the quarter one earnings, it was all already presented in their working capital. It was all visible. In Q2, it came fully to its daylight. So this is why I also advise spend some time on learning how to read financial statements, at least those three of the income statement, the free cash flows, the cash flow statement, and the balance sheet. If you can read those, you probably have already more understanding and more knowledge than most Wall Street people, because most of them probably never read the documents themselves. They just copy headlines and try to make the news and such. So if you're able to read those, you can pick this out. Yeah, you can pick this out. And I think you recommend a book the other time about this as well. We can put it in the description of the
Yeah.
podcast. So it's not rocket science that we saw this coming. So lumber prices up, yeah. So higher costs again. They were not able to pass that on to the consumer, and I find that surprising because when I'm buying toilet paper, I'm not thinking about whether it costs €2 or €2.20. Yeah, on the whole total of the bill, it wouldn't really matter if it's even if it would be €3. So I think they could increase the prices actually more than they expect, together with the competitors, of course. But also, Q2. Remember last year? I mean, we saw those pictures of people having cars full of toilet paper and everything. It's unrealistic to expect the same sales in this year after around this time. So they come from a really exuberant high level last year, plus increased inflation. Then I'm not surprised at all that their earnings are less now. What I'm then really a little bit just disappointed with, that it seems to be a surprise to the management, because the management is lowering their guidance now that Q2 kicked in. Well, they have to after half a year because they will not make the numbers anymore by the end of the year. So they reduced they lowered their guidance from $7.30 to around $6.65, which is quite significantly. That's why I also think the pre-hour the pre-hours price went down. I think they recovered during the day, went a bit up again. But come on, they shouldn't have been surprised by this from that point of view. They write these statements that I was reading, they write them themselves. So they should know what they write, but probably the accountants. But what you can see again in their, how you say it, in their free cash flow, again, they were struggling with their working capital. Their inventory went up. So it's really the inflation there. But what is probably what investors that are attracted at the moment by Kimberly Clark and the dividend need to know, it's the second quarter that their dividends are not covered by their free cash flow. It's a little bit better now than in quarter one, but their free cash flow is at the moment not covering their dividends, and they are borrowing money to pay it. It's as simple as that. Don't look at the EPS or the earnings, just look at the cash. They're not covering the dividends at the moment. And it's not that they are having the worst year either. Yeah.
I mean, come on. you're telling me that management did not know sales of toilet paper would go down this year based on last year? Uh, did they have their eyes closed? Or that's crazy. That's crazy. I mean that's incompetence from me, from a management perspective, that they don't foresee something as obvious as this. And we talk about not being able to pass on to the customers. Toilet paper is something everybody needs. Every single person needs toilet
Yeah,
paper. They were in the middle of a pandemic. Everybody was rushing out to the store. They could have raised those prices by 5, 10 cents at the time. Nobody would bat an eyelid because we needed toilet paper. They had a perfect opportunity. They missed it, and now they're struggling. I blame management. I really do,
yeah. This is
and
just poor management.
just poor management. And I believe they can pass that charge on to the customer. They still can. I just
Yeah,
don't know why they don't. To be honest, I
yeah.
don't know.
Exactly. And it's 3 layers or 4 layers of toilet paper. It's already probably a higher quality than their rivals with their own brands. So yeah, I think, or we don't understand their complexity of their supply chain, but I'm looking at it as a consumer, right? That I'm
Yeah,
willing to pay more for toilet paper. The last thing I think about is whether it's €2 or €2.10.
yeah. I mean, I buy the same toilet paper. I don't walk in and stand in the aisle and go, okay, this one is 2.10. This one is two. Okay, I'll buy the cheaper one. I know. I'm just going to pick up the one that I always use and put it in the basket and walk on like so.
Yeah, yeah. We're used to the feeling, right, of the toilet paper. You don't want to change that. It's not nice.
Exactly. Hey, Kimberly
Yeah,
Clark, listen to us. Just raise those
yeah,
prices and you'll be able to afford your dividends next quarter.
exactly. We want to keep wiping it with comfort. Just remember that.
I
There's a
keep
lot of there's a lot of stickiness to this to their brand.
I keep thinking of Big Daddy. Have you ever seen that that
Yes,
program
yes,
or that?
yes.
And the little guy, I wear my own ass. That's Kimberly Clark. Perfect advertising for him. Okay, we'll move on before we get out of hand. ABB was the last company I briefly looked at. It's a company that I can't believe I've never looked at more in depth before. As an engineer, as an automation engineer, more to the point, I deal with these products all the time. I was quite surprised actually that the robotics section was the lowest of their divisions. But I mean, they're everywhere electrical. They're everywhere in process engineering. They're everywhere in robotics. They're a really, really big company. And there's somebody that I want to look into a little bit more deeply towards the end of this year. So keep an eye out for a post. I'll definitely be doing a post on them either on my blog or on the European network blog. So looking at their earnings, their orders went up 8 billion, comparable to this time last year. So that's a 32% increase, which is quite good. Revenues were up 21%. Operational EBITDA was 1.13 million. I don't know what it was before, but I assume that's good because they had it in their highlights. Their basic earnings per share was up 150% based on this time last year. So I know COVID, especially in industrial situations, had huge supply chain issues and there was a slowdown. So they would have benefited from this because companies still needed their parts. It just took them longer to get it, and they're starting to see the benefit from that this year. So overall, I think it's really positive to see their sales going up. I think Europe again has shown strength and come back quicker than most other markets. And you look at their revenue per region, Europe is again the highest, followed by America. I expect America to catch up a little bit better next quarter or the quarter after, but quite happy. They had a net. They reduced their net debt by 5 billion, which is quite significant. So this time last year they had a net debt of 7.6 billion. This is now 2.2 billion. Like that's huge amount. On top of that, then they've announced a huge buyback scheme of 115 million shares. So they're doing quite some good things. I'm not sure how they stand from a valuation point of view, but I mean, their dividend is safe. They don't always increase it. They try to do it sustainably. I think it's held for the last 2 or 3 years, but they definitely try and give value through share buybacks where they can. So a company to look out for me, and I can't wait to dig a little bit deeper into their technicals.
Yeah, thanks for sharing that. And it's really one of those companies that I'm always intrigued by. And I checked their data like a few times, but it was already some time ago. It is such a company that actually could fit in my portfolio. Besides a company like Siemens, as an example, it really fits there, and it's a company that, like Siemens, benefits from the energy transition because they can both support the old energy and the new energy styles. So
Yeah,
it's really like it can easily transition with them because they are playing on both fields, and this is what I really like about ABB.
they are actually part or in the heart of the transition. So
Yeah,
they cover all the components you need to make that transition. So
Mhm.
it,
Exactly.
for me, they seem like a perfect fit for me, and I'm a little bit disappointed myself because there's some companies out there like ABB, Schneider, Keyence that play a huge part in my roles every day, and I've never looked at these companies. And I remember before, no, we give advice to newbies, giving questions, invest in what you know. These are companies I know, and I've never invested in them. So I'm going to have a look at more of those this year. The kind of capitalist and myself are going to come together and maybe brainstorm and maybe write a giant post. So it's something to
Nice.
look out for in the future.
Okay. Hey, cool. So, quarter two earnings. We're in the middle of it. Next week, really a big week. We'll have to pick out really some of those companies that we really need to look into because there are dozens of them.
Yeah.
But yeah, great. I really love this week already, and I like these kinds of earning seasons. But we have also some listeners' questions, so let's go get into that. And of course, the first one is from Phil, and maybe this one is for you. He said there were some talks about changing quarterly reporting to half year reporting, so twice a year instead of 4 times a year. Would you be for it or against it from a shareholder perspective?
I would not be against it, to be honest. I mean, quarterly reports are nice, but I think you get more meat on the bone from half year and full year reports. I mean, European companies already do it. They don't always give a full quarterly report. Sometimes they give a sales update, but I don't think we need to because we can get sucked into this quarter by quarter by quarter, expecting to like Intel, for example. We're expecting to see something happen within a certain 3 month period. If we don't meet expectations, share price drops. So I certainly wouldn't be against it. I don't really see it. I can't see it happening. I believe a lot of American investors might have a different view. They're so used to it, and it's different. But as a European, we already have that style over here, so
Yeah,
I'm happy with that.
cool.
Okay, so Enzo has asked us a question, and I'm going to ask this one to you. I think you touched on it above actually, but Unilever increases its sales by 5.7%. So how is it possible that they lose 2% in their earnings per share?
Yeah, so I touched upon that, and it's actually a really short answer, Enzo. They had a negative currency impact of 6.4%, which is already wiping out most of it, but also cost inflation. Just the cost of goods sold are higher. It's simple as that. If the currencies go reversed, you will see again a benefit next time. So
Okay. So basically currency impact, and that's it's one of the big drawbacks, isn't it, from investing in companies that are diversified globally. There's always going to be
yeah,
some currency. And my point with Roche earlier, they were in Swiss francs, so you always had that currency
yeah,
fluctuation. So, but hey, it swings around about you. You benefit sometimes, you don't others.
exactly. So the next question is from Bas Erlings, and he's saying, "Hey, the inflation game is on. Central banks still believe it will be only transitioned, and are not in a hurry to taper. Also, think about the rate hikes. So, what are your expectations for inflations, and what effects will possible central bank actions have on your portfolio?"
So look, there's no doubt inflation is here. It's been long talked about. We've spoke about it. You've done a great video on it. There's loads of resources from us on that. In terms of my portfolio, I just keep investing in the stock market. Uh, Technically, I have inflation ready portfolio with a 42% stake in consumer staples. They say stay with consumer staples because they pass on their their costs to customers. That was not intentional, by the way. I didn't do that because of inflation. It's just by virtue of the companies I bought. From my perspective, I'm just going to keep investing in the same companies. Look at the balance sheet, look at the cash flow. If they have a strong balance sheet, strong cash flow, I'm happy. So it's not going to change. It's not going to change me too much. To be fair, if I was to give advice to everyone out there, if you have a diversified portfolio, if you have real estate stocks, you're probably in a better position than I am.
Yeah. Good.
Okay, so John from the Money Pursuit, nice to hear from you again, John, has said, do you guys ever sit on cash for a long time? And this is not literally.
It's good that you mentioned that. Yeah, I've got a war chest. But I hope to spend it once totally, and I might never build it back up again because I think I've learned to trust more in dollar cost averaging over time, and yeah, so cash actually costs me at the moment money. And how often do we get these opportunities? Once in a decade, once in 5 years. So it's probably not money savvy to have a war chest.
Okay.
Yeah, go on.
The last question then is from Odysseus, and he's asked us our biggest surprise, good one, and deception. I already know your answer on this one, and deception so far on the earnings season. So we'll go with deception first.
Well, it's IBM because it's really simple. They're financially engineering the heck out of it. It's unbelievable, and people still buy it. People still believe what the CEO is saying. It's just utterly crazy. Yeah, and so it's deception, and it was my biggest surprise. Is there really a good big surprise upwards? Not yet so far from my side. Let's see how it will be next week. Good.
Okay, yeah, we have a big week next week, so we might.
Yeah.
I'm sure we'll see some good ones.
Yeah.
Okay, that's great. That's all additional questions. Thanks again to everyone. We might move on to our stock pick of the week. I'm going to a slightly different route this time. It's not a recommendation or it's not someone that I have, but it's a company that was brought to my attention by Enzo, who asked us a question earlier. And the company is called Bulkers Limited. So they're an industrial company, which we know I'm fairly light on at the moment. So I was quite interested to read about this company. So basically, they own vessels and they ship large like steel or large containers around the world. They have like cape sizes, which are really, really, really large ships that can't pass through, say, the Suez Canal or the Panama Canal. So it's quite expensive to hire these ships, and they make lots of money by traveling all over the world. The earnings growth has been growing at a really good rate over the last couple of years. They also pay a monthly dividend, which is quite interesting for a European company. The dividend payments have been low, but it has been increasing quite rapidly, particularly as the cape sizes rates increase. So at the moment, that's about 30,000, and that translates for them roughly a 25. Is it Norway? I can't remember what currency I have, but it's 25 of that currency dividend, which gives them a crown, yeah, and that gives them like a 25% forward dividend as well, which is huge. Now that's not sustainable long term, but if you look at their dividend potential, I'll post a little graph on this on my Twitter as well. You can see that their potential is quite huge based on their annual return. So it's an interesting company. I would suggest to everyone to look at it. I'm very, very interested. I think they're a new company, so they're only paying a dividend about 2 years. So I probably won't invest in them at the moment, but I will keep them on my radar for a little while. Their free cash flow, they generate enough to pay the dividend at the moment, so that's good. But again, it's highly depending on this cape size rate, so it's something to keep an eye on. So
it's quite speculative.
yes, at the moment, but I think it has potential.
Okay, cool. So I'll put the ticker in the description so that listeners can look it up. and very interesting. This one, very and kind of atypical for what we usually choose. So that was nice.
Yeah, and hey, a monthly European dividend stock. What more do we want?
Yeah, indeed, indeed. Well, safe dividends.
Exactly.
Okay. Hey, well, EMF, this is the end of the show again. Thanks. It went really quick. We had quite some earnings, and earning season has started. I really, I'm really energized by this. So let's see next week. It will be
Yeah,
great.
it keeps me going, and I must say to our listeners, if there's any company you want us to speak about next week, please drop us a tweet or mail or anything early in the week so we have some time to look at them. Because we would love to speak about companies you want to hear, not just companies that we want to hear about. So please drop that below for
Yeah.
us or on any of our media platforms. We'd be happy to do it. But as always, thanks, European DJ. It's been a pleasure. We have a busy week next week, so rest up over the weekend. And
Will
thanks
do.
to our listeners, and we will see you all next week.